Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Today, we're going to try to help you with your finances during retirement. You know, whether you're already retired or looking forward to it, we answer questions that are relative to really all ages to a large degree, things that you can look forward to if you're not retired yet, and things you might be able to deal with now if you are. So you can send those questions in to Ask Tom at talkmoneywithtom.com right now if you want. Send them during the week. You can also go on the chat if you'd like and put in a question. We'll watch for those. We'll try to answer them live. And so really enjoy that part of it. So please send in your questions. We originally put together this channel just really as an answer to a hole that we saw kind of in the educational system, so to speak. There's not a lot of information out there, I think, in this particular type of format about retirement. How to plan for retirement, how to manage your money during retirement, how to lower your taxes during retirement, right? Those are the three biggies, all of which can have a pretty dramatic impact on your finances, which, might help you have a more enjoyable retirement altogether. So you can subscribe to this channel. You go to the subscribe button, push that. You can hit the little bell right next to it and get notified when we put out new things. And of course, you can also, meet with us if you'd like. There's a book appointment button up in the corner of our website. Looks just like this, and the website link is here on the channel. Hit that, and you can schedule a time to meet with Ethan and I, face-to-face, phone, video, whatever you'd like, for 30 minutes, and we can kind of discuss your questions, on a one-on-one basis. So look forward to, being able to see you if you can. Otherwise, look forward to today's show, and hopefully we can help some people out here. All right, I always like to start off the show with a kind of a summary of what I saw happening with the markets this week. Let's start off with the signals, actually, because we have new signals all the way across. Some are new, but they're all green now. So the stocks, again, the fast signal just means that we are looking at things that are in IRAs and those types of areas where we don't have to worry about tax consequences for buying and selling. The slow signals, more for our taxable accounts. Both are green right now. And then our bond signals are also both green. They've been kind of struggling for a while,
Yep.
bond market, so it's nice to see it sort of rallying up here. It's had a really nice rally recently. So, and this is kind of what's happening right now, and I'll point out some of the main pieces here. So if we look at the chart, you can see here over the last couple of weeks, we've had a tremendous run up. I mean,
Yeah,
just one
I
of the
should
best.
go on vacation more often.
Yeah, that's right. Yeah, what's the last week was 5.9%,
Yeah.
right? And really was kind of incredible. This week we're up 4 out of the 5 days. Where are we at right now? Are we above 4,400?
Oh my gosh.
So this is a fairly important component of what's happening today, is just making sure that we're establishing a new high and that we stay above 4,400 at the close.
Yeah, so right now we're at 4408 for S&P.
Okay, we're just barely above it, but that's a big deal, actually. Lots of articles out there talking about 4,400. Closing above 4,400 would basically say that this downturn is over. I don't know if I agree with that completely, but if enough people believe in it, maybe we'll see some, motion in the market as far as that goes. But, you can see this particular chart. You got the big run up in 2021, peaking out, the very beginning of 2022. Giant downturns, and upturns happening all the way through 2022. You see those big peaks, but every one of those peaks was lower.
Mhm.
And we finally hit a low on October 13th of last year, and we had a pretty decent run. Still a lot of volatility, but we ran all the way up until the 31st of July, which is kind of nice. And now we've had, the biggest downturn since last October that's just happened. We hit this low just before Halloween, and we have been really flying ever since. And so let's just talk about kind of why we're flying. And it has a lot to do with what we've been talking about for quite a while now. And that's really this support zone. Yeah, 4,200 to 4,050 on the S&P 500. If you look inside those two lines, you see that the market spent a lot of time there. And it went sideways there, and it went up and down there. And what that means is that there were a lot of shares accumulated at that price. And so when the market ran, and it kind of ran too hard. If you look at it, it ran up out of that zone just straight up. It had to kind of backfill that, right? Because there just wasn't enough support there, didn't spend enough time at those prices. But the hope was, and so far it's been true, was that once it got into that zone, we might find some support. We might see some, buying happening, and a little bit of buying happening all of a sudden causes a bunch of, people that are shorting the market to buy the stocks back, right? And so that's, you get this run going, And that's exactly kind of what I saw last week.
Yeah, 5% a week is essentially could be a year's worth of return, or half a year's of returns in a week.
Yeah, and it is one of the problems with investing. It's one of the problems with kind of moving in and out or doing any of those things is that you miss one day like or one week like that because you were out for some reason. It's really easy to miss most of the returns for the year. Seen lots of stats that show the best 5 days of the year if you're out, you miss almost all of the return for the year. I'm making that up, but in general, that's the idea behind that. And so luckily for us, our system has us in really, I think, since February, just because the market is in an upward trend. Yeah, and once it's in that primary upward trend, and again, the things we look for is lows that are higher over and over again. So you can see we had 4 of them now, including this last one. All of them are higher. And that's why I was not so worried about this particular downturn, because we've just kind of gotten ahead of ourselves. It had quite a ways to go to establish a new low that was lower, which then would have triggered some alarms for me, but we weren't there yet. We were just getting into that zone. And so, even though we were down 10% from that high, part of the reason we're down 10% is because we were up, 10, 15% just before that, and kind of a crazy run, really kind of fueled by the debt ceiling being resolved, and then the NVIDIA's, unbelievable earning results revolving around the potential for artificial intelligence, right? It kind of created that big jump. And so we settled back in. That's great. I think that's healthy. This is what's supposed to happen. Having that continue to go straight up past July, everybody might be excited for a while, but that's what happened in 2000.
Oh, yeah. Yep.
And things went so nuts. I remember, I think it was 1998, the NASDAQ doubled, It sounds great. Sounds like fun, except for the problem is once it gets so stretched out, it starts to come back down almost as fast, and then it creates a panic. And all of a sudden you're down 45% from the high, and you've got this huge downturn that we're still talking about. So, you don't want that. You want these little runs, and then you kind of consolidate, pull back, little runs, pull back. And so what we're doing right now is actually quite healthy. In my opinion, it's working. Inflation is still on the decrease, which we really want to see. And so, those are angles that I think are important. And then, of course, if you look, one of the things that was happening here that was somewhat concerning is we were starting to establish another trend where the highs were lower.
Yeah, which is kind of scary.
Yeah. Yeah, it's exactly what happened in 2022. All 4 of those big highs were lower. We were doing it again, but that's what's so significant about this week. We actually broke through, right? And we established, it's a little hard to see that here, the third high was at 43.76, right? And so we closed above that twice, Tuesday, Wednesday, and then Thursday, we were down, 0.8% yesterday. And I talked about this on the Wednesday video. I talked about how, the Federal Reserve was going to be out in force and doing all these interviews and different things, question and answer sessions. And Chairman Powell is going to be speaking on Thursday. And in November 1st, they came out, they didn't raise rates. And they said, we don't need to raise rates, especially since the market is already kind of raising rates for us because the 10-year Treasury was all the way up to 5%. And so all of a sudden, the 10-year Treasury ended up at 4.5% yield. And so that makes easier monetary scenario, which is not what you want if you're the Federal Reserve and you're trying to tighten monetary supply so that inflation can continue to drop down to their 2% target. And so I was worried that they were going to come out much more aggressively, and that's exactly what happened on Thursday.
Yeah, if you looked at the CME FedWatch tool, it went from 95 to 85%.
Yep.
Today it's back up to 90% of like holding rates. So you can see how the market shifts so much on those comments.
Yeah, they call it job owning, right? So they're going to try to job own the markets into reacting so that they don't have to raise rates as much. And they've been doing that, and this is not completely normal. November of 2021 is when they really started doing this. And it creates all kinds of volatility. It works to a certain degree, although look at how much we're up really since the October low of last year. So it's not really working. They've been trying. The markets are the markets. They're going to overcome job owning in the end. And look at this last one was one day. We gave away 0.8%. We were up 1.3% before the show started here. on the S&P anyway. And, so because the reality is that the market is really, in a spot now where we're starting to confirm the next leg of this upturn. If this downturn leg that we're on now is going to be officially over, which really would happen when we get above it, but nonetheless, there's like a checkbox, right, of different things we look at. We checked off, hey, we made it past 43.76, check. We set a new high that was higher than the previous highs. Next one is, hey, we got above 4,400, big psychological thing. The next one would really be set another high past that second high, and then of course the last one would be get back to that high of July. We're a ways away from that. November is the second best month of the year historically. This is the beginning of the best 6 months of the year historically also. So there's some good things that are happening. And part of the reason we might have sold off so much at the end of October is that mutual funds are allowed to capture their losses up until the 31st of October for the year. So any losses they gather after that would happen for next year. And so you see a lot of selling to capture those losses. And then, you got to buy something with that. And so you get that big V scenario that we have here.
Yeah.
Could be partly, revolving around that mutual fund, deadline that's happening. And so November can be a good month. That helps. Now, there's another thing that happened here that's really interesting. There's a gentleman named Martin Zweig. He's a famous investor, and really from our time frame. And he created a buy signal. It's called the Zweig breadth thrust indicator. And what it does is it looks at these very strong downward movements followed by a very strong upward movement within a 10-day period. And I'm simplifying that dramatically. It's actually fairly complex. That has only flashed a positive signal 18 times since 1945. So it's not very common, but it's sort of famous because of those 18 times, 100% of the time, the market was up a year later, and the average rate of return a year later was 23% up.
That's a pretty massive return.
It is. I mean, the market average is 11, right? It's a double. Yeah. And even the shorter term returns after they signal are pretty good. 8% return after a quarter, 3 months, and 15% average return, for the market after those 18 things for the 6 month. And so, the market is doing well. And again, of course, here's what we're looking for today. I'm a big believer in the close. We're above it right now. The close is not here yet. This is a live show. It's not recorded. We're not editing it. We make mistakes. It's kind of interesting to watch, but I'd like to see this market close today above 4,400. Not the end of the world if it doesn't, but it's reacting very, very well. And kind of everything we started talking about back in June, hey, the market is stretched out too far, and it kept going for a while, but we were talking about a consolidation phase. We have that. Now we've seemed to have bottomed out that consolidation phase, and we're starting to hit check marks to get past that consolidation phase and continue up with this primary uptrend. And the next leg of this uptrend historically would be the strongest leg. And so, we'll see if that is true or not as far as that goes. We do have some, clouds on the horizon with the fact that the Federal Reserve has raised rates so much. And the impact to those rate increases are lagged pretty dramatically. So you've got this situation where you raise rates today, you might not see it for 3 to 18 months. And so they raised rates from 0 to 5.25 to 5.5, right? I mean, in that they have a range that they use for where they're targeting, and that's a big jump, right? It's a lot. It's not a big number. 5.25, 5.5 is really a nothing. If you look historically at where the Fed funds rate had been, I'm not worried at all about that level. I mean, it was at 19% in the late 70s, early 80s to try to break that inflationary spike. So that's a lot more than where we're at now, obviously. But again, the best 5 years in the history of the stock market was 95 to 2000, and the Fed funds rate was right around where it is now. So it's not enough to really slow things down. It's just sort of a shock to the system, and there's an adjustment that happens, and we go from easy money to tighter money, and the things that require easy money are going out of business.
Yeah.
Right? They are. And these kind of zombie companies and what have you. as they need to refinance that debt to stay alive, which they've been doing because money was easy and now they can't get it because money's tighter. Commercial real estate could suffer from some of those things, all of these things that are out there. However, this is all being offset at the moment by the consumer. Maybe the consumer backs off at some point in time, but you lock up the consumer for a few years, they get out and they want to go do things.
Yeah, people are spending at such a high rate right now.
Yeah, and we're seeing it in high credit card debt, right? We're seeing kind of record credit card debt, which isn't a good thing, but is still a part of the story for what's happening here. And the reason, and this is the biggest thing to me, the number one reason that everybody got this wrong, okay? We were supposed to have this big recession this year. I mean, if you look at the second half of last year, I'd say over 90% of the articles I read, they were making a prediction about recession where it was going to happen in the first or second quarter of this year. That's not been true. Matter of fact, we just had a gross domestic product report for the last quarter was 4.9%. I mean, it couldn't have been more wrong. Mm-hmm. And what they're missing is that historically, when you raise rates from 0 to 5.25, 5.5, you get a recession. I have no problem with that. I would have been all over that because that is too much of an adjustment, too many things, something ends up breaking, all that stuff. But when you have this during a pandemic recovery, that's the difference.
Yeah, you got all the extra money you get to burn through.
Yeah, and there was extra money put out, right? Probably a lot of that's been used. Although I have seen some stats just recently, there's still a tremendous amount of money sitting in the banking system, in different types of savings instruments, that can come in. There's a tremendous amount of money that's not in the markets from the professional investors. Just last show, 2 weeks ago, we showed that Bank of America Bulls bear sentiment, which was ridiculous. So the fear was off the charts, right? Which is exactly what you want to see, because once that happens, the market takes off. Look what happened. I mean, that was 2 weeks ago we talked about that. The last 2 weeks, I think the market's up, at least 8 out of those 10 days, and up pretty substantially. This is a good environment. It's a good time to be an investor. It's a good time to kind of pay attention to what's happening. There's a lot to be learning. Now, I will say we're also at a fairly critical juncture here. We really don't want to break down all of those check marks that we just accomplished, getting to that new high, breaking up out of that support zone, and setting up above 4,400. We don't want to uncheck all of those here because then we're not out of the woods. So, what's going to happen here in the next week or two is really going to probably set up the rest of this run one way or another. Are we continuing down and developing this kind of, next leg to the downside, which again, there's a lot of people out there that think that might be what's happening, or are we breaking that little downtrend that we just had since the end of July and steadying up? This is the couple weeks here, in my opinion, that we really want to watch. The pattern's right now. I'd say the only thing that bothers me is look at how straight up that is.
Yeah, it's a really fast
send. There's some others, right, back there in 2002, right? There's a couple, but they all ended up failing pretty badly in the end too. So, when you get these big moves like this, we're bound to have some kind of, a pullback here. And yesterday was one part of that, in my opinion. But it doesn't have to happen because there is a lot of on the sidelines. But it does make me concerned when markets move too far in one direction quickly. So we'll see how that plays out. But it's an exciting time to be watching this. This is historic. The pandemic, the recovery from the pandemic. My theme has been for years here that we're just unwinding the pandemic. You look at where we're at right now, where, if we take a linear regression line going back to the bottom of the 2008 downturn, we're kind of right where we should be. Mm-hmm. You look at the bond market, a huge bubble up all the way back down. We're right at where we were in the bond market, at least using the Vanguard Total Bond Market Index as a proxy, where we were in 15, 16, 17. We spent years there. So, good, bad, or indifferent for any results that we've had, in the last few years. We're kind of where we should be. Market is setting itself up to kind of continue moving forward to the way that it normally does. But, we'll see if that happens. But anyway, that's what happened this week. An exciting week last week, actually, too. So it's fun to talk about. But look forward to being able to talk about it again next week. Hope you can join us. All right. What's our first question?
So, what are the different types of taxes someone can encounter. And what type of tax is the federal income tax?
All right. Yeah. So this came in on a comment on our channel. So we did manage to get a graphic for this, and it's kind of interesting actually. There's progressive, regressive, and proportional tax. Right. Those are the three main categories. So a federal tax rate would be progressive, which just means the more you make,
The more you pay.
the not just the more you pay, because even if you had this, if you so for example, if I was at 15% and I made 100,000, I'm going to pay what 15,000. If
Yeah.
I'm at 200,000 of income, I'm going to pay 30,000. But what happens is I actually jump up to say 20%.
Yeah. So you have
I'm making these numbers up, but
a
yeah,
larger percentage.
yeah, it's a larger percentage. It's not. It's going to be a larger dollar even if it's the same percentage as you make more. But then it's a larger percentage also. That's very progressive. And so, the more you make, so what's the top bracket now? 37% on the Fed.
Yeah.
Yeah, and so the more you make, the more your money goes. Now, it is tiered, right? So you only pay, what 10% at this level, and 12% on this money, and then 22% on this money, et cetera. I'm making these brackets up. I think they're close, but that's what progressive is. You pay more, and the percentage goes up the more you make. Now, regressive tax, right, is just the opposite. You actually end up with less and less tax being paid as a percentage of your income. The one example that we thought of before the show was Social Security taxation.
Yeah. So FICA taxes always cap out at a certain income amount, and so once you start exceeding that income amount, that percentage goes down and down.
Yeah. So, for example, if the cap is 140,000, and one person makes 40,000 and another person makes 100,000, they're both paying the same percent. That doesn't change. But let's say somebody makes 500,000. They stopped paying on Social Security at 140. I forgot what the cap is, but it's somewhere at 180 something in that neighborhood. And so, as a percentage, because you're no longer paying, your percentage of your total income is dropping down. All right, so your capped is what you can pay. There's been a lot of talk about upping that cap, getting rid of that cap, these type of things in order to kind of, fund Social Security. But that's a good example of a regressive tax. Then a proportional tax, otherwise known as a flat tax, really. I know there was a proposal by Steve Forbes in one of the election cycles. I think he was running for president, of having a 15% tax. And it was kind of famous because he was talking about, hey, you'd just be able to file your tax return on a postcard. There's no write-offs, no nothing. You'd write down your income and your 15%. But some of the examples are...
You got sales tax, so like everyone pays the same sales tax, or sales taxes if you're in the same area, I guess.
Yeah, so I guess we're at, what, 8 3/4 or something. I've lost track of where our sales tax is. So what that means is no matter what you make, or no matter how much you spend in this particular case, you're still paying the same tax, this 8 3/4. They have a VAT tax, value-added tax in Europe, right? Kind of a national sales tax and whatnot. So that would be an example of proportional tax. They all have their place, I suppose, but it's good. It's a good question to kind of understand how it works. And our federal tax system and our state tax system here are both progressive tax systems.
It could be different per state. Some states may have a flat tax or
Yeah.
a proportional tax.
Actually, I don't know if I've seen a flat tax one, but really close because the brackets are so wide. Almost everybody's in, one area. And so, or no tax, right? Nevada, Texas, what have you, have no state tax. They generally will tax in other areas, property taxes or high sales tax or something along those lines. But that's a good question. All right. So what's our next question? There we go.
Why is renting in retirement so dangerous compared to a mortgage?
Renting dangerous compared to a mortgage. Well, the most obvious thing is that rents can go up and up and up over the years. And if you're youngish, and you might live 20, 30 years in your retirement or 40 years, whatever it might be, you could have, I think we did a little calculation, right? So $2,000 rent at 3% growth is $4,800 and change, so about 150% more rent. Whereas if I had a $2,500 mortgage, it would still be a $2,500 mortgage 30 years later if I had a fixed mortgage rate, right?
Yeah, and so the idea is that with renting, you have a constant outflow that keeps growing. With a house, you may have some house maintenance, but the idea is that you don't have these constant outflows other than the mortgage, which is fixed.
Yeah, it's really interesting because you know, I own a home, right? And I built that home from scratch, or had it built. And, 7 years in, everything started falling apart. And, your house is in a constant state of decay. And, different things are happening and you're having to pay for that. If you're renting, you call your landlord and that's their issue to deal with. The roof that has to be repaired, the increasing property taxes or whatever might be happening. Now, generally speaking, in a an economy that works properly, you'll probably end up paying some of that as part of your rent increases anyway.
Hmm.
I mean, the landlord isn't there to lose money, and so if their costs are going up more than your rent's going up, and they start losing money, I think your rent's probably going to go up pretty soon,
Yeah.
in most cases. So, however, it does kind of insulate you from that immediate cost, of that type of thing that happens. We had a pipe burst in our wall, took out 800 square foot of, hardwood floors. Was insured, but we still spent $6,500 on a deductible. If I was a renter, I would have been inconvenienced, but the landlord would have had to deal with that, upfront cost.
Yeah, and renting can not be dangerous too.
Mhm.
If you're in like your later stages of your retirement, renting may be beneficial. Not worrying about maintaining the house. You don't have to worry about big expenses like replacing a roof. If something breaks in the house that's disastrous, you don't have to worry about it because you have, the landlord will take care of that kind of stuff.
Yeah, many of these retirement communities have a form of kind of renting. Some you can buy in, some you end up with some equity, some you don't end up with any equity. Kind of depends on what it is. But there are a lot of seniors that are renting, in essence, right? They no longer own a home. They're living in this retirement community, and they have maybe some access to higher level care within that community.
Hmm.
You got independent, and then what's the one after that? The assisted living,
Living.
and then nursing care, memory care. I mean, those are probably the four big levels. And so there's nothing particularly wrong with that. I mean, at least I mean, everything's included. Sometimes the food, and also.
And the nice thing about that is usually when you get to the later stage of retirement, you don't fall victim to long-term inflation.
Yeah.
That constant growth doesn't really affect you in that. It doesn't have that enough time to catch up to you.
That's right. If you move into one of those retirement communities, you're going to have a 5% a year increase on average, it seems like to me. However, it's not for the next 30 or 40 years if you're 80. Yeah, most likely. And so it's just what Ethan's saying is just you have less exposure to that and less danger from that. Your assets might be okay to kind of handle that. Be nice to run a plan and make sure that's true. Make sure that things are set up properly. But that is in essence, it's a good debate because I've actually seen, there's one gentleman out there that's talking about, renting for life. He's a younger guy, and it just depends. If you've got a house that doesn't appreciate at all, and there are a lot of them out there,
Hmm.
and that can be, detrimental. You spend all this money, you spend it to get set up to sell it, and then you sell it for less or the same amount that you bought it for. Because that's the other kicker with buying versus renting, that possibility of getting some appreciation. And certainly in our area, it's been awesome. I mean, incredible appreciation. And so, that's nice too, because you get in there, my fixed cost for my mortgage, yes, I might have maintenance, but I'm also maintaining a property that is gaining in value. So I don't really have a lot of problem with putting money into it because it just keeps gaining in value. Now, that won't happen forever, and there's
Hmm.
lots of examples historically of areas that have had trouble. But that is another piece of if you're in an area that has very poor historical gains on property values, which can happen, then it's a little bit of a different calculation, at least for that part, because that can be one of the biggest kickers to me. I guess the last thing is it's yours versus somebody else's.
Yeah, you don't have to ask, can I hang
Yep.
this up or can I new to do this renovation of the kitchen?
Yeah, I ran, had a 100-foot line run of 220, 100 amp line out to my detached garage, dug up everything on the planet to get it under the house, out to the detached garage. and because I needed 220 to operate some of the machines I'm using out of my garage. And, if I didn't own that place, maybe I could have done it. But, I'm doing a lot of stuff to that garage that I wouldn't be able to do if I owned it. I tell you that much. So, but I really like that. It's mine. I get to deal with it. Yeah, there's a responsibility for upkeep, but I like being able to do what I want to do. So yeah, personally, I try to buy. Now, it's assuming you can, right? I mean, a lot of people rent because they can't buy. That's fine too. I was in that boat for a really long time, so nothing wrong with that.
So, what is the widow's penalty, and how do I protect my spouse from it?
Okay, so this is a subject that really I think is underappreciated. It's not being talked about enough. There is a aspect of our tax code that is wildly unfair. Okay, and I'm seeing it on a daily basis within the clientele, and I've been trying like mad to get everybody to kind of understand what this is and how this works and how you might be able to deal with it before you get kind of stuck. Okay, so we do have a great visual here, which we'll show you. So we've got Jill and Bill, all right? And so Jill has 24,000 right there in the middle of Social Security. Bill has 48,000, and between the two of them, they have 60,000 a year of required minimum distribution. Okay, taxes under the married joint filing taxes, federal taxes in this case would be $11,053. Probably standard deduction, that kind of thing, right? Now, Bill passes away. The larger Social Security stays, right? The smaller one disappears. It's a little bit more complicated than that, but that's essentially how it works.
Yeah.
So the 48,000 stays, the 24,000. So Jill now has less income by 24,000. Still has to take the required minimum distributions because no matter who owned them, now Jill owns them.
Yep.
Right? And so they're all under one person. And now Jill is filing tax returns as a single taxpayer, not as a dual taxpayer. Jill's taxes are $17,000.
Yeah.
So
in total, she loses 24,000, and then she has to pay additional 6,000. So she has basically 30,000 swing.
30,000 swing. It's huge. And so here's what I'm seeing, and here's the problem with this. And this really revolves mostly around RMDs because there's more problems than just tax. You also have Medicare. And so Medicare is means tested. And they'll allow you to have a bit more income if you're married than if you're not.
Yeah.
And so what happens then is all of a sudden you might have been paying the lower amount of Medicare and a single person's already paying more. And it's pretty dramatic. I mean, you can get 50% more Medicare costs pretty quick. And in this particular case, for Jill, that could be permanent because they have this required minimum distribution that needs to come out every single year. And so here's the big thing that I'm seeing that you just need to think about in advance. You have a couple, you both have 401ks, you're both working, you're building up this money, you've built up quite a bit of money, it's millions of dollars, you retire, right? It's fine. You get to required minimum distribution age, right? Start taking money out, but you're under joint tax returns. You're under joint, testing for Medicare. You still might end up paying more if you have enough in your 401ks, but it's still okay. One passes away, and all of those 401k assets and IRA assets combine into one person's name. In this case, Jill.
Yeah.
And she ends up as if she earned all of that herself. Because that's different. If it's just you and you have that 401k and it's $5 million, great. But it wasn't. In this case, let's say you both had $2.5 million and you were able to kind of split that because of it's a joint tax return. Now all $5 million is in one tax return, and somebody like that is paying max Medicare and getting hit heavier on taxes, even though they lost a chunk of their income because some Social Security disappeared.
Yeah, it's interesting because the tax system basically thinks, okay, you have two people, so you just double it.
Right.
But in real life, if you have one person pays probably like 60 to 75% of what two people pay because a lot of those costs you overlap.
Yeah.
And so it's kind of a system.
It's a mistake. There should be an adjustment. There should be an RMD, reduction based on the fact that it was two people that acquired that money that's being forced out. There should be, hey, part of my income is coming from my former spouse that's maybe somehow accounted for on the tables for Medicare, because that's the one that people really get upset about is Medicare. They see it every month. It's a big,
Yeah.
a big dollar amount, but the taxes are there too. And and how do you deal with that? Well, number one, consider a life insurance policy, because people aren't. They think, oh, I got plenty of money, I don't need life insurance. Well, you're just going to saddle your single spouse with all of this taxes and all of this extra money for Medicare, because the taxes went up 6,000, the Social Security went down 24. It's a $30,000 differential. There
Yeah.
could be another $6,000 differential or so on the Medicare also. And so think about that. Maybe it's worth having a life insurance policy to take care of your spouse for that excess expense and loss of income that's going to come. So that's one way. A lot of people don't like insurance. Maybe you don't qualify. Maybe you're too old by the time you hear this. That's fine. Another concept is to try to start to fairly aggressively move your 401k IRA type assets into Roth IRA type assets.
Yeah, with tax rates being at historic lows.
Yes.
Maybe it's while you're still joint filing, it's a good time that you can maybe start to pick at it. You don't have to do all at once, but take chunks at a time.
Anything you could do would be better. If you can lower that RMD to 50,000, that's better. I mean, it's just less tax, and it is possibly less Medicare also. So ideally, you start to do those conversions before 73 when they start making you take the required minimum distributions, and you just basically you could take what would equivalently be the required minimum distribution out and start early. Yeah, you're going to pay tax. And yes, but you do get tax-free growth, and there's no required minimum distribution on that Roth IRA for your spouse. So you could effectively eliminate this problem before you pass away if you were aggressive enough on your motion on required minimum distributions. But even if you can't, anything you can do is better. So life insurance, but planning around this possible event. I guarantee you, if you stop the average person who had a couple that had, even if just one person has the big IRA, like let's say Mr. worked, he has the $5 million IRA, Mrs. stayed home, it doesn't matter. When one of them passes away, there's only going to be a single filing tax return, single income. You're going to pay more taxes. You're going to pay more, on Medicare. And so anybody who has that scenario needs to be thinking about what's going to happen when one of them passes away, and they're not. They're not doing insurance because, we got $5 million. We don't need insurance.
Yeah.
And you're right, except for this problem. And maybe don't need a lot of insurance, to be honest, because this isn't a huge problem. But believe me, this is something I can get a couple of my clients on the line here really quick, and they will be really adamant about this because they already are. They understand what's happened to them, but it's already too late. Their husband or wife has already passed away. And so I'm trying to get out there and let people know in advance that this is something to think about. This is something to deal with in advance while you can, because it's pretty important, and it just makes your retirement so much more enjoyable if you've got this part figured out. And it's really kind of an irritant if you don't. So it's a great question as far as that goes. All right.
So why do growth stocks change values change so much with interest rates?
Okay, so I'll give you the analytical, technical definition that everybody gives me, which is if you have what they call the PE ratio, it's the price to earnings ratio, right? So if I have a stock that is at $100 and the earnings are $10, right, my PE ratio is 10. Mm-hmm. What that means is that if the price stays the same and the earnings stay the same, that over the next 10 years, that company will earn the $100 price that it's worth, right? So when you're looking at an investment, it is essentially that it's a discounted cash flow. How far out do I have to go? In this case, 10, because the PE ratio is 10. And so the longer I go, the more I'm going to discount it because money's worth less in the future.
Yep.
And then when you discount it back at a rate. So when you discount it back at 1%, you're going to get a value. When you discount it back at 5%, the value that you get to figure out what that stock should be worth is going to be lower. Mm-hmm. So a tech stock or growth stock often has a much higher multiple, 30 times. That means it's 30 years out. So it makes a much bigger swing, right? Because now I'm waiting 30 years instead of 10, and the interest rates aren't 1 anymore. They're up at 5 or 6. And so that discounting mechanism for cash flows, and of course, some of these growth companies have 300 times earnings or they don't have earnings
Yeah.
at all. And so that's a piece of it. Now, you were mentioning an interesting point too about these companies that don't have earnings. Sometimes they're borrowing.
Yeah. Sometimes you're using debt just
Right.
to get through stuff, or you a lot of rather than issue new equity, they're going to use debt, and so as debt becomes more costly, you can't get as much. Less free money means you don't put much money in.
So it kind of puts that company at risk, right? I mean, they're already at risk anyway because they're a high flyer, hoping that they can start making a profit. And we've seen lots of companies eventually turn profitable and do quite well. I mean, Amazon wasn't profitable for a long time. Google wasn't profitable for quite a while. These are companies that are now profitable by miles.
Yeah.
So sometimes that's how it works. And so some of that funding to pay that deficit comes from venture capital, but some of it comes from debt. And so if debt becomes more expensive, that makes it much harder for that company. So it generally hits the growth area pretty heavy when we start to see interest rates. And we saw that last year. So we saw, in general, like the QQQ, which is the NASDAQ 100, was down more than the overall market, right? Because it's tech related, higher multiples, what have you. And we also saw some of the more, aggressive growth type issues like the Kathy Woods ARK fund, ARKK, was down significantly more than QQQ, again, because higher multiples and or companies with no earnings. And so that environment, you also have, especially when you get out into that extreme arena of higher growth companies, you end up with, more susceptibility to economic interruption. So when rates are going up a lot, they're at risk of, that big 2008 downturn, which, will wipe out a lot of these weaker players that were still in the process of becoming, the next Amazon could get wiped out in a huge recession because they just couldn't get through it. And they had a kind of a tenuous financial position, had lots of revenue growth, but they weren't quite settled yet. Give them another 5 years, they're good, but then boom, they raise rates and knock the economy down, which is norm, right? It didn't happen yet this time, and didn't happen, in the time frame people seemed to think it was going to happen. Nothing broken. Actually, something did break when Silicon Valley Bank went out of business, but they managed to shore that up, and such too. But that's what happens with growth. Now, you do see them come back. Like this year, halfway through the year, the QQQ was up, 40%, which is ridiculous. And it's obviously slowed down. And so, but that you'll see, because that's kind of where the sizzle is. It's where the excitement is. It's not in these deep value companies per se, although there are people like Warren Buffett who have made tremendous amounts of money on deep value. But the excitement in the market is generally these companies that are, these faster growers.
And also, when interest rates come up, if you hit a certain point, people are willing to give up risk or returns because you can get risk-free or low-risk returns.
Yeah, that's right.
And so there's less money out there.
Yeah, the interest rate bearing investments, CDs, bonds, what have you, become more competitive. If the stock market's averaging 11% and you could get a 10% CD, guess what? There's going to be a lot less money going into the stock market, right?
Yeah, I rather take that guaranteed 10% than have that fluctuation.
Yeah, we'll back up the truck when that happens. Anyway, that's our show for today. I want to thank everybody so much for coming today and listening to the show. We really enjoy doing this. We'll be here again next Friday. And please send in your questions. Put them in the comments, send them on the email, whatever works for you. We'll try to answer those. And we enjoy that. And, if you have a question, somebody else probably has that same question. We can all learn from it. And that's what this is about. This is an educational show. And we have an educational channel. You can learn a lot by going onto our channel and start watching I put out a video every single day on the market. You can learn a lot about how the market works. We put out this show every Friday, almost every Friday. We break the show up and we put those pieces out online also. So if you see subjects that are interesting to you, great. Hit the subscribe button, hit the little bell to get notified. And of course, we're available to meet, and come visit us. Book appointment button up in the corner. and we'd be happy to meet with you for a half an hour, phone, face to face, video, whatever works for you. So look forward to seeing you again next week, and thank you very much for coming today.